A Random Walk Down Wall Street is a seminal book by economist Burton Malkiel. First published in 1973, it has become a cornerstone of investment literature, guiding millions towards financial literacy. The book challenges conventional wisdom, offering a straightforward yet powerful approach to investing. Malkiel, a Princeton University professor, argues against predicting the stock market. He posits that stock prices behave more like a random walk, making future predictions unreliable. This groundbreaking concept shook the investment world, challenging traditional stock valuation methods. The book's enduring relevance lies in its timeless principles. Malkiel advocates for long-term investment strategies, emphasizing the importance of diversification and understanding market dynamics. His insights remain valuable in today's ever-changing financial landscape through clear explanations and real-world examples. Malkiel empowers readers to make informed investment decisions. A Random Walk Down Wall Street demystifies complex financial concepts, making them accessible to both novice and experienced investors. Imagine a coin toss. Predicting the outcome is impossible. Just like short-term stock movements, Malkiel argues stock prices fluctuate randomly, influenced by news and sentiment. These factors are unpredictable, making market timing difficult. Instead, Malkiel advocates for a long-term perspective. Over time, the market reflects a company's true value. Focus on the long term to benefit from overall market growth. Central to Malkiel's argument is the efficient market hypothesis, or EMH. This theory posits that stock prices already reflect all available information, making it impossible to consistently outperform the market through individual stock selection or market timing. The EMH suggests that information disseminates rapidly in the market. As news breaks, investors quickly analyze and act upon it, causing stock prices to adjust accordingly. This efficiency makes it challenging for investors to gain an informational advantage. Malkiel acknowledges that markets are not perfectly efficient. However, he argues that inefficiencies are generally small and short-lived, making them difficult to exploit consistently. Attempting to capitalize on these inefficiencies often leads to higher trading costs and potential losses. The EMH has significant implications for investment strategies. If markets are efficient, then actively trying to beat them through stock picking or market timing becomes less viable. Malkiel suggests that investors are better off focusing on broad market exposure and minimizing costs. Malkiel champions index funds as a simple and effective investment vehicle. Index funds track a specific market index, such as the S&P 500, providing investors with broad market exposure at a low cost. Actively managed funds, on the other hand, employ professional portfolio managers who attempt to outperform the market through stock selection and timing. These funds typically charge higher fees due to their active management approach. Malkiel argues that index funds consistently outperform actively managed funds over the long term. He cites numerous studies showing that a significant majority of actively managed funds fail to beat their benchmark indices after accounting for fees. For example, a 2023 study by the Spiva found that over the past 20 years, 91.4% of actively managed US large cap funds underperformed the S&P 500 index. This evidence supports Malkiel's assertion that actively managed funds struggle to justify their higher fees. The advantages of index funds: simplicity and diversification. Index funds offer instant diversification and are simple to manage. They track broad market indices, reducing individual stock risk. With low expense ratios, they keep costs down for investors. Malkiel suggests a simple portfolio of low-cost index funds. Long-term investment strategies are crucial for success. Malkiel emphasizes the importance of a long-term investment horizon. He argues that short-term market fluctuations are inevitable and unpredictable. By focusing on the long term, investors can ride out these fluctuations and benefit from the overall upward trajectory of the market. He encourages investors to develop a sound investment plan based on their financial goals, risk tolerance, and time horizon. This plan should outline asset allocation, diversification strategies, and a disciplined approach to investing. Malkiel also stresses the importance of regular saving and investing. By consistently contributing to their investment portfolio, investors can benefit from the power of compounding. Over time, even small contributions can grow significantly, especially when reinvested. He cautions against emotional investing, where decisions are driven by fear or greed. Instead, he advocates for a rational and disciplined approach, sticking to the investment plan even during periods of market volatility. The perils of market timing and stock picking cannot be overstated. Malkiel advises against market timing and stock picking. Even professionals struggle to time the market or pick winning stocks. These strategies often lead to underperformance. Malkiel suggests a passive approach with index funds. Practical advice for wise investing is scattered throughout A Random Walk Down Wall Street. Malkiel provides practical advice for individual investors. He emphasizes the importance of understanding investment fees and expenses, as they directly impact returns. He encourages investors to diversify their portfolios across different asset classes, such as stocks, bonds, and real estate. Diversification helps mitigate risk by ensuring that the portfolio is not overly reliant on any single asset class. Malkiel also stresses the importance of patience and discipline in investing. He reminds readers that building wealth takes time and that short-term market fluctuations should not derail long-term investment plans. He encourages investors to seek professional financial advice when needed. A qualified financial advisor can provide personalized guidance based on individual circumstances and goals. Empowering investors with knowledge is a central theme of A Random Walk Down Wall Street. This book remains a timeless guide for investors of all levels. Malkiel's insights into market efficiency, the randomness of stock prices, and the benefits of index fund investing continue to resonate today. By understanding these principles, investors can make more informed financial decisions, avoid common investment pitfalls, and increase their chances of achieving their long-term financial goals. Malkiel's work empowers investors with the knowledge and tools to navigate the complexities of the financial world and build a secure financial future.